Hi class, now I want to work quick study 4-7, which is a great representation. Without making the video way too long, it's a great representation of how to handle sales transactions. Okay, so we're going to prepare journal entries to record some sales transactions. Okay, so we've got April 1st. Sold merchandise for $3,000, granting the customer terms of 2/10, end of month, invoice dated April 1st. The cost of the merchandise is $1,800. Well, how interesting. Why did they tell me the cost of the merchandise? Well, it's because under the perpetual system, I am going to immediately debit cost of goods sold and credit inventory for the amount of goods that are going out the door. Okay, that's what's awesome about perpetual inventory. So if we gave the customer terms, that means we billed them. So what are we going to do? Well, we're going to debit accounts receivable for $3,000. Okay, and we are going to credit sales. Okay, then we can't stop there. We're going to record the cost of goods sold, which they told us was $1,800, and we are going to remove that $1,800 from inventory by crediting inventory. Okay, so there's my full transaction. And every time you're at Walmart or the grocery store and they scan your item, the computer automatically makes this entire entry. Okay? All right. Then on April 4th, I can already see we're going to have trouble. April 4th, the customer in the April 1st sale returned merchandise and received credit for $600. The merchandise, which had a cost of $360, is returned to inventory. Now, a lot of times people return things because they're damaged. So if the problem tells you they're damaged and they want you to put them into like a damaged account, it will tell you that. If it doesn't tell you specifically that the stuff was damaged, you assume that you turn it back, that you put it back into inventory. Okay? So what's going to happen here? Well, you might think to yourself, well, we need to undo the sales for that $600, but that's not true. See, on the sales side, we make it a lot more complicated. On the purchases side, we just took our returns back to inventory, and we took our discount to inventory. It's not that way on the sales side. On the sales side, we like to look at a lot of detail. So we are going to actually use a debit account called sales returns and allowances. Now, do you see that it has a debit balance? What that tells you is it is a contra account against sales, which has a credit balance. Okay, so $600. And guess what? They're not going to pay us for that, so we're going to reduce their accounts receivable account for $600. Can't stop there. We got to put $360 back into inventory and reduce cost of goods sold. Now, since I've got returns and stuff going, I'm going to be a little confused about what that customer still owes us. So I'm going to keep my T account here. Because don't forget, every customer really has their own accounts receivable account. Like if we were using QuickBooks, every single customer has their own accounts receivable account, and we would know what that balance was all the time. So at first, they owed us $3,000. Then they returned $600 worth of stuff. So now they only owe us $2,400. Okay? Then on April 11th, we received payment for the amount due from the April 1st sale, less the return on April 4th. Okay, so guess what? They're going to pay us. Notice that we're just 10 days past April 1st, so that's the big hint that the customer is going to take the discount. So guess what? They're going to pay us some discounted amount that I don't know what it is yet. So what I like to do is I like to reduce accounts receivable for the whole amount that they owe us, because that's what we're going to have to do. Even though they take the discount, we still have to get their whole account showing paid up, okay? And then we'll figure the discount, sales discounts. Notice that we keep a separate account for sales discounts. That's different than the way we did it on the purchases side. But we want to see how much our customers take advantage of this. Okay, so it's 2%, so it'd be 2% of $2,400, because remember, they returned some stuff, so that'd be $48. So the discount would be $48. So how much cash are they going to pay us? $2,400 minus 48, so I think that would be $2,352. Yeah. Okay, so see, $2,352 is what we collected on a $2,400 balance. Okay? Okay, that takes care of that problem.